Multifamily real estate investing has become really popular over the last couple of years, and with good reason. It's a great way to grow your portfolio quickly, and you can generate some really good cash flow. The problem is, I personally believe that multifamily prices are heading for a decline. So in this video, I'm going to share a couple of different market analyses with you. First, I'm going to share 3 markets that I think pose the most risk in the coming months. Then I'll share 3 markets with what I think is the greatest potential for all-around returns, just strength across the board. And then 3 markets that have the best cash flow potential for multifamily investing. And now, a moment of silence for cash flow. Actually, never mind. Cash flow is back thanks to our friends at RentToRetirement. RentToRetirement offers newly built or renovated, leased and managed turnkey properties so you can invest with confidence and secure the cash flow you need. Single family, multifamily, new builds, BRRRRs, they've got it all across multiple markets, and they have no money down options as well. Get the team, the systems, and the cash flow you need to start investing today. Visit RentToRetirement.com or call 800-311-6781 to start investing in some of the best cash flow markets today. If you look at publicly traded multifamily assets like REITs, you'll see that they're down like 15 to 20%, and that's often a really good lead indicator for what's going to happen with private valuations. And that's obviously going to create some pain for existing investors, and people who invested recently, really over the last couple of years, are going to be impacted the most. Now, before we get into those markets, I just want to caveat and make clear what I'm saying. Even the 6 markets here that I think are good markets with relatively strong long-term fundamentals, I do think there is going to be a short-term correction, as I said. So before we get into those markets, I do just want to caveat my advice here. When I say even these 6 markets that I do think have good long-term fundamentals, I'm not saying you should go out and buy at current market rates right now, because I do think prices are going to decline. What I'm saying is that if I am correct and prices do decline, that these areas might be ripe for opportunity for future growth. I'm not saying you should go out and necessarily buy anything that you can find in these markets. So just want to be crystal clear about that. Okay, so let's just start with the 3 markets that I think are really at the biggest risk of a crash right now. Number 1, and I know I pick on this city a lot, is Austin, Texas. And I know Austin has a lot going for it over the long run, but right now the situation for multifamily really doesn't look good. So right now in Austin, cap rates are really low. They're at 4.36%. And if you're not familiar with cap rates, it's a way of valuing multifamily. And just generally speaking, just so you know, for the purposes of this video, when cap rates are really low, that means that asset prices are really high. It's really expensive to buy. And generally speaking, across the country, cap rates are at about 5.5% right now, which is historically really low. They've been declining really since the Great Recession. And so Austin is even below that, which means there's not a lot of room to go lower. Typically, as a multifamily investor, what you would love to happen is for cap rates to go lower, because that means even if you change nothing about your business, the price goes up. But when the opposite is true and cap rates go up, even if your business is profitable, it tends to push prices down, because cap rates are basically a measurement of what investors are willing to pay for a given market. And so in Austin, what's going on is with cap rates already really low and market conditions pointing generally just across the board that cap rates are going to go up, that's probably going to mean that prices are going to go down, but that's true everywhere. The main thing about Austin that really concerns me is that there is so much new construction right now. There are currently 44,000 units under construction. Meanwhile, rent growth is already flattening out and is sort of starting to come down. So when you think about the fact that all of this new supply is coming online, where rent is already stagnant, that probably means that rent is going to come down. We're also seeing in vacancy, even though all these people are moving there and there is relatively high demand, compared to a few years ago, there's just too much supply. Vacancy rates for multifamily are already near 10% and are forecasted to go up to 12%. And this is happening despite demand growth. Like, I can look at data and show that demand has gone up 10%. But since there's so much construction, it is outpacing supply. And I think that's going to hurt net operating incomes, which pushes down prices. So when you compare lower net operating income and higher cap rates, those two things combined mean that prices could fall pretty far in Austin. That said, Austin does have great long-term fundamentals. I just think it's going to take a while for the market to work through all of this new construction that's coming online over the next couple years, and for prices to really even out, and for investors to really get a good sense of what like a good, reasonable price is in that market. The second market I think is at a really big risk for decline is Punta Gorda, Florida. They just have this insane level of construction. So I did this analysis looking at how much new construction is coming online compared to existing multifamily inventory. And in Punta Gorda, in the next 2 years, the inventory is almost going to double. And that is insane. I mean, obviously we need more housing, generally speaking, in the US, but that much supply coming on in one specific market in that short of a time comes with a lot of risk. You already see that the vacancy rate is about 12%, which is higher than the national average. But according to CoStar, which tracks this kind of stuff and makes these forecasts, they expect vacancy in Punta Gorda to go up to 25% in the next 2 years. Meanwhile, cap rates, which we were just talking about, are low. They're at about 5%. So that means people are paying a really high premium right now for multifamily assets in a place where vacancy is expected to go to 25%. We've also seen rent already start to drop. It's dropped 2% over the last couple of years, which isn't terrible, 2%, but that's before vacancy nearly doubles over the next couple of years. So I do think that there's a big risk in Punta Gorda, despite, again, strong demand growth. And I think you'll see this theme in the markets that are going to crash is that demand is growing in these markets. So they're solid, economically sound markets, like the economy is growing and all that. It just seems that developers got overeager. They saw all this population growing into these areas, and then they built too much. And so that's at least true of Austin and Punta Gorda. When we get to our third market, which is Santa Fe, New Mexico, again, we see huge construction. 42% unit growth in the coming years, and cap rate is really low. It's 4.8%, even in a market like Santa Fe. I've been, it's a super nice place, but it lacks the robust economy of a place like Austin, right? Like Austin has all these jobs, there's huge companies moving there. But Santa Fe, all this construction, cap rates of 4.8%, for a market that doesn't have a well-diversified and growing economy like some of these other places, that to me is a little bit risky. And again, the theme here holds true. Vacancy in Santa Fe is expected to nearly triple. It's really low right now, under 5%, but it's expected to get to about 14% over the next 2 years. So again, all three of these markets, they have strong demand, but there's just too much construction. Vacancy is going up. Cap rates are going to go up. And with NOI declining, I think you could see at least 20% declines in each of these markets. All right, those are the ones that I will personally be staying away from until prices come down. Once they really go down, they could be great places to invest. But some of the markets that I think will hold up well over the next couple of years, again, they still might come down a little bit, but I think they have stronger fundamentals than the three I already mentioned. So number one is Panama City, Florida. If you look at the returns in Panama City just over the last year, they're about 16%, which is pretty good, but a lot of that is based off of appreciation. There is still good cash flow for multifamily investors. It's just under 5%, and cap rates are still super low. The good things about Panama City, though, is that rent is growing still. A lot of multifamily markets are seeing rent flatten out or decline, but Panama City has 2.4% rent growth over the last year, which is great. And there's relatively little construction. And I think that's the real difference between Panama City, some of the ones that we talked about before, is that demand is growing. But unlike those other cities, vacancy in Panama City is at 11%, but it is forecasted to go down. There's just not as much construction. And so the increasing demand is actually eating into that vacancy instead of those other markets where increased supply is adding to that vacancy. The second all-around market that I really like is Lynchburg, Virginia. Over the last year, they've had about 15% returns with a cash flow rate a little bit better than Panama City at 5.5%. Rent is growing, not a ton at 1.1%, but again, compared to other multifamily markets, doing pretty good. Demand growth in Lynchburg is supposed to be really high. They're expecting household formation to increase by 12%. And so that will really help boost the economy if all these new people are moving to the area and more households are being formed. Again, you see that there's 11% vacancy, which is near the national average, but it is expected to go down to about the mid 7s, which will be really low, especially given the context of what else is going on in the market, the rest of the multifamily market. To me, Lynchburg is really just this classic example of a place where demand is outpacing supply, right? There is some construction, not a ton of it, but a lot of people are moving there. There's a lot of household formation. And if you know anything about economics, when demand outpaces supply, prices tend to go up. So I think that bodes really well for Lynchburg. The third all-around market that I really like is Columbus, Ohio. Columbus has the lowest overall returns of these three at 12.5%, but it has the best cash flow at about 6%. You know, rent growth here, again, it's less than 1%, but it's doing okay, and demand remains solid. The thing about Columbus is that it's a booming economy. There's all this chip manufacturing coming to the area, which should bring high-paying jobs, but yet construction rates are actually reasonable right now. They're not going crazy. So that bodes really well for the solid, but not crazy demand growth of 4% over the next 2 years. Obviously people know about this chip building plant. And so people are pricing that in, and cap rates for a place in Ohio are relatively low at about 5.8%. But this is a market that seems poised for really strong long-term growth, and is one I will be personally keeping an eye on. Those are my three all-around solid markets. I'm going to move now to my three top cash flowing markets. And if you're wondering what the difference is, there tend to be trade-offs. Like if you are looking for pure cash flow, it is usually in markets that don't appreciate as much as like the markets that I was just talking about. And so I've picked markets that if you're mostly focused on cash flow as an investor, these are three markets that can still do well. And doesn't mean your property prices are necessarily going to decline more than on the national average or anything like that. Consider that these three markets will probably not appreciate as much as the previous three, but they have better cash flow. The number one here is Cedar Rapids, Iowa. It has a 7% return. But all from cash flow. So if you remember from the previous markets, they were getting 12, 13%, but their cash flow was like 5%. So a lot of that was coming from appreciation. Now that appreciation might slow down because I do think, like I said, in a lot of markets on a national basis, prices are probably going to drop. So if you want to be safe, you can consider investing in a place like Cedar Rapids, Iowa, because they're not getting a lot of appreciation. And so you wouldn't be counting on that. You know that going into that, but you would be getting a 7% cash on cash return with rents continuing to trend upward. Vacancy is really low in Cedar Rapids and it's forecasted to fall. And so this might be a market that offers good cash flow potential now and actually better in the future because, again, demand is outpacing supply. The next market is Cleveland, Ohio, and people like to dog on Cleveland, but it has pretty good fundamentals. Demand forecast is up. The population, it's not growing, but it's relatively flat, and that does come with a risk. Don't get me wrong. Population growth isn't the only thing that matters with demand. The other thing is household formation, like how many people are getting married and starting a family, or roommates that are breaking up essentially and splitting into two households. That dynamic seems to favor demand growth in Cleveland right now. And so vacancy is not super high. You're getting a 12% return over the last year, and cash flow is still near that 7%. And so I think that is a really good cash flow market. The last one of my cash flow markets is McAllen, Texas. It has an 8% total return over the last year. Again, 7% of it cash flow. The McAllen, you should know that rent growth is down. It's gone down a little bit, but demand is forecast to rise. And so because rent is down, maybe prices will come down here a little bit more. But if you look out a couple of years, demand, population, household growth is going up in McAllen. And so it is likely that vacancy, which is already pretty low, could stay low due to really low construction, but strong demand. Okay, so those are the markets I have. Let me just recap. 3 markets. And again, these are just 3 markets that I picked 3 of each. There are plenty more in each of these categories, but 3 markets that I think sort of are good examples of the markets at the biggest risk are Austin, Texas, Punta Gorda, Florida, and Santa Fe, New Mexico. The markets that I think offer all around pretty good strength, they still might decline over the next few years, but I think they'll hold up relatively well to the rest of the multifamily market, are Panama City, Florida, Lynchburg, Virginia, and Columbus, Ohio. And for markets that really focus on cash flow for investors who are really focused on that, you can consider Cedar Rapids, Iowa, Cleveland, Ohio, and McAllen, Texas, just to name a few. Again, there are plenty that fall into each of these categories. That's all I got for now. If you have any thoughts about these markets or think of markets that fall into one of these categories, I would love to know in the comments below, so please share them. I'm Dave Meyer for BiggerPockets. Thank you so much for watching. Again, if you like this video, please give us a thumbs up, share it with a friend, and I'll see you next week.